Hello and welcome to today's episode of On the Mark Financial Literacy with Mark Zinman. Thank you for joining us today. Good morning, Mark.
Morning, Monica. How are you? How was your 4th of July?
It was very fun. We watched the Black Sabbath concert. What about you?
I spent some time with my grandchildren. So always good. So I just want to share one thing. So my wife said to my 3.5-year-old granddaughter, is your grandfather old? And she said, no, he's just fragile.
So, you told me that story the other day.
Apparently fragile. So, yeah. So I'll try to hold myself together for this episode.
Well, over the 4th of July weekend, you decided to pivot a little bit and you wanted to talk about the big, beautiful bill today. So that's on our agenda for today.
Yes, the phone call started about 5 minutes after Congress passed it. So I figured it's an apropos topic to get out there right away to our listeners.
So let's jump right in.
So it's called the Big Beautiful Bill, and I will tell you, depending on who you are, beauty's in the eye of the beholder. So just like it is, we've been told. Just like any bill, whether it's Democrat or Republican controlled, these bills come out. This happens to be, there was during the Biden administration, there was one on, energy saving things, home credits that we got a lot of play on. This is going to be sort of similar. It's a 900-page bill. It's going to take weeks, and we'll probably be talking about it on podcasts going forward as they determine what is really buried in that 900 pages. I know they read it in the Senate. The Democrats required them to read it in the Senate, and it was in the middle of the night, so I'm positive that if it was a tax bill, most people who were listening, even on C-SPAN, fell asleep. So it's going to take Congress a little bit to figure out what's in the bill, and there will be some congressional fixes. That always happens. So we're going to discuss what's in the bill, but basically there's a no action here as far as anything regarding our listeners, how they pay taxes, how they pay their estimates. I don't believe there's a material enough difference for those people to worry about it right now until we hear more. So basically my advice is listen to what I'm going to say. Monica, you and I are going to go through a few things. If they think they pertain to you, that's great. And we'll have to figure out what that actual value is later on. Mm-hmm. Okay, so...
And I imagine...
Yeah, sorry. And I imagine, you said?
I imagine as time goes on, there will be some more information that you can share with...
I think every day this week, through the professional channels I have, I've heard things that I didn't know before. They're not, earth-shattering, but they're enough that somebody who's a tax professional might be interested in knowing that for their clients. So, yes, something's coming out there.
Great. So, great introduction for those that are that were unfamiliar. Do you want to jump in?
Yeah, let's go. What's
your first topic on seniors?
First one you have a question of it. Come on, tell me.
Okay, so Social Security and seniors.
Okay, so the big thing. So let's just talk about this bill a little bit. It got a lot of headlines. So one of the headlines is I fixed it. I fixed it, meaning Congress fixed it. So there's no such tax on Social Security. That is not true. There's still tax on Social Security, but what they did add was an additional deduction for people who are 65 or older. It's either $6,000 for single people or $12,000 for married filing jointly. The one thing to keep in mind is, and as we talk about all of these have had bullet points in the media, but what they keep not bringing up is there's phase outs. What's a phase out? So at a certain income level, the ability to take that deduction, the $6,000 or $12,000 that we just discussed, will be reduced until it ultimately gets to zero. So for this one, it starts at $75,000 for single people, starts at $150 for joint. One of the things we don't know yet is where it phases out, like how fast it phases out. So those schedules haven't been out. But yes, and this deduction will be available to seniors whether they itemize or not.
Mark, can you share some information about changes as it relates to child tax credit?
Yes, so the child tax credit had been $2,000. It'll now be $2,200 per child. So, depending on how many children you have, that'll be helpful, and I think that'll benefit a lot of our listeners.
Also, we have some activity here with auto loan interest deductions. Can you tell us a little bit about that?
I can tell you about that one. I will tell you this one is a little bit of a pitfall. So there's now up to $10,000 deduction for auto interest on auto loans. It has to meet certain criteria. So it's only for cars that are bought in 2025 through 2028. It only applies to cars that are assembled in America. So here's where we have to be really careful. Just like, I guess, if anybody had been interested in electric vehicles, the credit only applied to certain cars and there was a list published. I'm assuming there'll be a list published by the IRS. I mean, Mercedes, BMWs, Mazdas are made in the United States, some models, and some models of Chevys are made in Mexico. So depending on what the criteria of the bill is, will determine whether or not this is applicable. This again has a phase out. It starts at $100,000 for single, $200,000 for married filing jointly. And I will probably say that the practical use of this is if you're going to buy a car, the same way that maybe people went to buy cars and they would consider an electric car because it had a $7,500 credit and figure that into their value proposition, I think that the ability to deduct some of the loan interest would factor into the net cost of a car. The interesting thing about this that I think is going to be helpful is, again, this interest deduction is in addition to whether you can itemize or not. So you don't have, a lot of, when we talk about itemized deductions, you have to get over the threshold, which is like $30,000 for married people, or $15,000 for unmarried people, or single people, single people. So this is going to be in addition to that. So it will definitely benefit our entire audience if it's applicable.
Okay. And does that apply to both vehicles that are purchased in 2025 and after that are both new and pre-owned?
I don't know the answer to that. Great question. So I don't know if it definitely applies to new. I haven't heard about used. This is kind of the stuff that we need to hear about as Congress. So what ends up happening is Congress passes a bill, and then the Office of Budget Management starts to put an interpretation out. Maybe the IRS puts an interpretation out. And depending on what that interpretation, that may lead Congress to make an adjustment to the bill. So yeah, I think in this case, it's something that should be known. I wouldn't be running out and buying a car that you fit just because you can deduct the interest, because I don't think there's enough information to make that decision. And yeah, used cars would be one of those questions that we don't know about the answer yet.
Don't go anywhere. We'll be right back after a quick break from today's sponsor.
Running a business is hard. Managing your finances doesn't have to be. At Zinman & Company, we specialize in accounting, tax strategy, and business consulting tailored to your needs. Whether you're a startup or scaling fast, we've got your back. Visit www.zinmanandcompany.com or call us at 215-357-2250 to schedule your free discovery meeting today. Zinman & Company, where clarity meets confidence.
So state and local taxes. SALT deductions.
This has been a big one. So we talked in an early episode about the Trump 2018 bill. The SALT was state and local income taxes. So in order to itemize previously, you have to get over the threshold. I already mentioned the threshold, like $15,000 for single, $30,000 for married clients only, thereabouts. Prior to this bill, up to you have to actually incur it, but up to $10,000 of taxes. That would be real estate taxes or state and local, which is anything other than federal tax and Social Security, is part of that deduction. And to the extent that you exceeded $10,000, you were capped at $10,000, which meant that for a married filing jointly couple, you'd need $20,000 of other in order to get any benefit out of the taxes. They've now lifted that cap to $40,000. This was how they got it through for those states like California and New York that have much higher taxes than some other states. So it's now going to be $40,000. But again, this is another pitfall where the phase out begins at $250,000 for single and $500,000 for married filing jointly. And you say, okay, well, $500,000, that's not a lot, but how much you pay in tax is a reflection of how much you earn. So yes, I think a lot of people will be able to deduct more than 10, but how many people will be able to deduct 40? So it will help. This tax increases by 1% a year, so it's $40,000 this year. So 1% means in 2026 it'll be $40,400. And there was a discussion in the bill about, so a lot of states did a workaround called a pass-through entity tax, where you could pay an additional business tax in lieu of paying your state tax. It was a way to work around the $10,000. This may affect how you participate in those taxes. So again, you'd probably have to confer with your tax professional in order to understand whether you should be doing the pass-through entity tax if it's offered in your state, or you should just take the SALT deduction. But again, this was a big one, and I think that This will benefit a lot of people. I think this is probably one of the more broader applicable stuff in the bill.
We have two huge categories coming up. Let's take them one at a time. Having to deal with workers, employees, and their compensation and taxation on that compensation. So taking them one at a time, could you share some information about the changes that we'll see regarding taxation that tipped employees will, how that will change, taxes on tips?
Okay, so it's tax on tips and tax on overtime. Then we're going to do tax on tips first. But this is probably the most unfair part of the bill, and I'll share why. So you potentially have two people who earn the same amount of money but get it in different forms that are going to pay different taxes. And we are definitely talking about middle class people here with overtime and tips, right? So I'm a manager at an Amazon facility and I make $100,000. I'm a worker at an Amazon facility and I get paid $70,000 plus overtime, or I'm a waitress and I get tips, but I'm a person in the kitchen and I just get a salary, right? So we could potentially have people that earn the same income who are going to pay different taxes because of this. And yes, this is completely to try and appeal to the campaign promises that were made. But the no tax on tips means that on the first $25,000 of qualified tips, so for those employees who have worked before, there's a box on your W-2 that says how much of your wages were tips. That's where we're going to get this information from, and that will then not be taxable on your income. The phase out of that's fairly high for this. It's $150,000 and $300,000, $150,000 for single, $300,000 for married, filing jointly. I say it's fairly high because I don't believe that people who are tipped employees would necessarily have incomes above that, since that would be mostly middle class people. Couple things they have to keep in mind: the tips have to be so. We're going to expect that a lot of people are going to try and create a way to deduct money that they, I'm going to be tipped now, I'm going to have overtime now. But keep in mind, it has to be industries that were where tips were common, and the tips must have to be bona fide, voluntary, not a bunch of criteria. But you're a waitress or a waiter or a busboy who shares in the tips or pool tips, you will be. This is something that will help you, and a tax professional will help you figure that out. And again, there are some states I know that are also adopting the same federal rules. So it's possible that you also could save state tax on these tips. So again, those rules will come out as time goes on, and we're not recommending that you make any changes to how you pay your taxes in, just because we're just not sure of the actual net result of what the tax savings will be.
And then continuing with the second part of that, taxation on overtime. And you and I had a conversation yesterday morning, I believe it was, about the reporting of overtime. So maybe you can talk about the changes and then how an employee can expect to report those overtime wages going forward.
So that was the first thing I had. So the way it works is that up to $12,500 or $25,000 if you're married filing jointly of wages paid as overtime can be deducted in order to compute. It's called adjusted gross income, but basically it'll come off your taxes. The interesting thing here is that right now there is no way other than your pay stub. In order for you, like you would look at your pay stub and it may have, regular wages, overtime, bonus, the different categories, but on your W-2, it only has one. It was disclosed yesterday that there will be a new line on the W-2 for which, just like tips, the overtime will be disclosed as a separate number from the regular wages so you can deduct it. This one will be phased out again at $150,000 single and $300,000 for married filing joint, which I think are reasonable numbers, so that I think there are a lot of people will be able to take advantage of this. Again, as we've talked about a million times, we don't want you to do anything about it because we just don't know the value of it. Whether or not this one will flow through to your state is less likely than the tips. I think for some reason talking about tipped employees, even more than overtime employees, tend to refer to employees that are considered to be more middle class, so it's more of a political window there to get some positivity for the politicians to maybe say no tax. So I think that no tax on tips is more likely at a state level than no tax on overtime. But again, I don't know. I mean, I wish somebody would ask me what tax rules, and I'd make them up, and I'd have better ones, but nobody asked me. I'm the person that interprets. I speak tax language. So it's we all need to wait and see on a lot of this stuff, as I've said several times already. But I think that the SALT, the no tax on tips, and the no overtime, if you're applicable, will result in some tax savings for you.
Okay. Charitable deductions.
This one I love, and we had it once before. I think it was during COVID. It was so one of the problems with charitable deductions, and I would say that 90% of my clients, if not higher, give something to charity, whether it's your church or give away clothes or make donations to the Red Cross or whatever you do. People want to do that, and historically there's been a tax benefit for that of being able to write it off. But under these itemized deduction rules, which we currently have, again, $10,000 of under the old one, $10,000 of taxes, you needed $20,000 or something else to get it. You get the greater of your standard deduction or your itemized deductions, and so your standard deduction is 30. You'd have to have itemized deductions that go above that 30,000. And what are the other itemized deductions? It's medical, it's interest on your home, and it's charity. So if you have $10,000 of taxes, you need $20,000 or more or something else. And that's a very large threshold to get through. If you had a mortgage that was at 3%, the first $750,000 of mortgage interest is deductible. I just think it's a hard one. So what does this do? But this one's at 2026. Starting in 2026, single is 1,000, married filing joint is 2,000. You'll be able to take a deduction above the line, meaning that you'll get your standard deduction and get the charity deducted. I think this is a great benefit. I think this is one of the issues I had with the original rule from 17 or 18 was that it took away, and I mentioned this in an earlier episode, there were social aspects to taxes, and one is to reward people for doing certain things that society wants them to do, and people want to be charitable, and society wants them to be charitable. This sort of makes that again a reality for a lot of people. I would like to mention some of the business ones, a highlight of them. So the big one for business owners is that they made permanent the 100% bonus depreciation. People remember that was in effect. So anybody who buys something, cars are excluded because there's some limits on that. But you buy any piece of machinery or equipment, you have to depreciate it over a certain period of time, or you were able to take 179 deduction. That 100% deduction got phased out, so I think it was 80% last year. It was supposed to be 60% this year. That's made permanent now, so that should hopefully be a boost to small businesses out there who need to buy equipment and know that they can not only buy that equipment but write it off in the year they bought it. It solves a problem that we've had for many years with research and development, and I know that sounds like, oh, I don't have any research and development. A lot of small businesses apply and are applicable to a research and development credit. And one of the issues there is that a mistake by Congress that was made like in 2020 or 2021 made it so that you had to take research and development costs and amortize them over 5 years, which means that you'd have to take them as a deduction over 5 years. So what ended up happening is that you would apply for the research and development credit and it have really no benefit because you would get the credit, but you have to pay tax on expenses that you couldn't deduct. So Congress realized that, and our unfortunate dysfunctional government that we had, they needed a common vehicle in order to fix it. This had bipartisan support, so this fixes that permanently, so that now our research and development is straightened out. It does a bunch of other things. Most of them are extending items that were in the 2017 tax rules. The big thing that people should know is that some of the things we had are going to go away. The $7,500 credit for electric vehicles is done at the end of September. I mean, there's been several iterations of this rule. It was on certain cars for a certain number. They've changed over the years. We still see that advertised a lot on TV, but in any form at all, whether it's through a lease credit or an income credit, it's all going to be gone by September 30th. So buy your electric car before then if that's what you want. I believe that this bill will affect some of the other things, like there are credits for windows, doors, furnaces, stuff like that was in the climate type bill that the Biden administration passed. I believe some of those are gone, although I'm not sure which ones, but it's something to definitely look at. I know I saw an article in the paper that Energy Star or the appliance certification that a lot of appliances have. That's going away, and that was another way of getting the credit. So there's a lot of things going on that we need to pay attention to. So it's not all positive. There's some stuff that's going to come back. So solar electric, solar panels is going to be scaled back. A lot of the stuff that was in the climate control bills were going to be scaled back. That actually benefit everyday Americans. So, you get good and you get bad. So if you're a tipped employee who gets overtime, you're really in great. Who also collects Social Security, who makes less than $100,000. This bill's for you, babe.
So again, 900 pages, 7 topics for individuals. You touched on some topics for small business owners. Thank you for that additional information. What advice would you provide to viewers or listeners? What response should they have? How should they change what they do, if at all, in response to this bill that just passed?
I think that they should keep like I've always advised that everybody should have a tax professional or somebody that can rely on for tax information. And I think it's something to have a discussion with them maybe after Labor Day. Like, I would do nothing at this point because we need to hear more. We've had headlines so far: no tax on Social Security, no tax on overtime, no tax on tips. And that is the truth. It's just not the whole truth. And so we don't necessarily know where it affects people. So we need to wait. Us as professionals, I know that I've talked to other accountants that I know, and we're all the same thing. This is not unique to this bill. Any bill that gets passed by Congress, we need to wait for the interpretations. So it's not a political thing at all. It's just that this is how these things go. Congress doesn't always read the 900 pages, although you think they will. So this stuff, I think the people that read it are business reporters, accountants, and maybe TV people, and then they bring it up, and then Congress realizes there's things in there that they didn't intend and want to fix it, or they're looking for interpretations. Tax bill is a little like the Bible, right? It has like a section and a phrase and whatever, and then there are many people out there who interpret that. And so we would need the interpretation of the language in order to understand how it applies in real life. But it doesn't mean that what we discussed here isn't true. It just means that it may be limited or a little different in your situation, and we have to wait to see how your situation would match up to the reality of the bill. So again, after Labor Day, I think we'll know more. I think that, Monica, you and I discussed that, we want to have relevant topics on this regarding financial literacy, how it affects our individual listeners, our small business listeners. So I am sure that somewhere in, if not a whole podcast, maybe a piece of the podcast will be on things that come out that were factual that we can share with our audience. So, stay tuned to us and we'll help you out as well.
Okay. Well, we want to thank today's sponsor, Zinman & Company, for sponsoring this episode of On the Mark Financial Literacy with Mark Zinman. Please visit our website, onthemark.cpa, for more information, to submit a question that you would like discussed in a future episode, to perhaps submit your name as a guest host. We love to have additional talent joining Mark here as we record these podcasts to give different perspectives. We want to thank everybody for listening today, and we look forward to seeing everyone next week.
All content provided on this podcast is for informational purposes only. No representations are made as to the accuracy or completeness of information that is presented. On the Mark, its owners, collaborators, and guests will not be liable for any errors or omissions, nor for any losses, injuries, or damages from the use of this information.